Hello and welcome to Wespath's third quarter institutional investment webinar. My name is Joe Halwax. I'm the Managing Director of Institutional Investment Services here at Wespath. We have a great webinar lined up for you today, one which I will remind viewers that you can watch as a whole or in parts at any time on demand on our website. In just a moment, I'll be speaking with my colleague Karen Manczko about what happened in the markets in a lively Q3 and how it affected Wespath fund performance. After that, we'll hear from our Chief Investment Officer, Johara Farhadieh, as well as Trent, Sparrow, and Sylvia Poniecki from our Impact Investment team about our affordable housing investment program and a recent visit they took to a property that we have invested in. Finally, you'll hear from Frank Holsteen, Quach, and Raj Khan about a question that's on a lot of our minds right now. Will the upcoming U.S. elections impact markets? But first, here's the latest at what's going on at Wespath. We have a new quarterly investment letter from Johara and the investment team. You may know this is going to replace the quarterly blog that we've been producing for the past couple of years. In this quarterly investment letter, you're going to hear more about the key takeaways that recap the market for Q3, but also some thoughts on why passive investing still requires active investing decisions, and also talking about market cycles and the concept of patient investing. We have a new blog series called From the CIO. And this is going to give you some thoughts into Johara's thinking as we look on what we're working on the investment team, in particularly three focuses that Johara has talked about a lot. One is investment excellence. The second is an inclusive approach to asset manager selection. And finally, a close personal connection to the missions of our clients. Regular viewers and readers may notice a blog that Raj and I did back in August about the yen carry trade. If you remember, the yen carry trade back in August caused a lot of market anxiety. And as a final reminder, we're launching a new fund in early December for Social Values Choice in the I series for institutional investors. And you can learn more about that by clicking the icon here or by contacting members of the Wespath Institutional Services team. Thank you for attending today and for trusting Wespath to steward your assets. Let's get to the webinar. I'm joined now by my colleague Karen Manczko. Together we'll be discussing both markets and Wespath performance. Welcome, Karen. I have to mention that a few people at a recent Wespath-led event mentioned our webinar sessions, and they said that we do a nice job and we seem to be having fun. So I have to say that was very much appreciated.
We all love feedback and certainly want to keep making these sessions valuable for our clients.
All right, so let's get after it. Summer markets can be a bit sleepy, but not this summer. In July, we saw some soft U.S. data that basically was the final impetus for the Fed to cut rates, followed by some volatility in August on the back of the Japanese yen carry trades, and finally the long-awaited Fed rate cut in September by 50 basis points. Between all this economic news and a sharp escalation in the Israel-Hamas conflict, we did not have a quiet summer.
No, we certainly did not. But despite some of the themes you noted, markets were strong and closing the quarter near all-time highs. And we finally saw some rotation in U.S. stocks, meaning we saw more of the rally away from the Magnificent Seven and mega cap names and stronger returns in the mid and small cap space. As an example, the S&P 500 market cap weighted index, where the largest companies had the largest weighting, was up 5.9% for the quarter. The equal weighted S&P 500, which is where each stock has the same weight, was up 9.6% for the quarter. Can you guess what the driver of the rotation was?
I don't recall any big earnings surprises, so I'm going to guess lower interest rates across the board was the driver.
It certainly does feel like the markets have rewarded the mid and smaller names with expectations of lower rates. But remember, the rotation really started in July before the Fed actually cut rates by 50 basis points on September 18th.
All right, so let's quickly look at some of the data in the quarter that led to the rate cut. Because as you mentioned, the rotation from large to small in the U.S. started in July. So in mid-July, we saw the soft inflation print in the U.S. and this broad tone of concern, the wall of worry. It shifted away from inflation and onto growth, meaning inflation looks to be more under control and more predictable, and the bigger concern for the Fed now is on economic growth. So with this shift in focus, the markets really started to price in a series of rate cuts.
Yes, they did. July saw a major shift in rate expectations. Remember at our April update, the markets were only pricing in 25 basis points of cuts for the year.
Yeah, I sure do, and that sure changed quickly as inflation eased.
But at the end of July, the markets were pricing in 125 basis points of cuts, with some economists even calling for an intermeeting cut and noting that policy rates were too high for the economy that was slowing. So in this graph, you can see the huge shift lower in the yield curve for the quarter. For some context, the 2-year yield fell over 100 basis points on the quarter to 3.64%, and the 10-year yield fell 58 basis points to 3.79. And do you know what you notice about this yield curve, Joe?
It's much less inverted.
Correct. We have a somewhat normal-shaped yield curve, meaning rates are lower on the front end than on the long end. As a final note on the yield curve, the 50 basis point cut on September 18th was a fairly big event. While it was priced in since 1990, the Fed has never cut rates by 50 basis points outside of a looming recession or during a recession that was already underway. Yes, it's a very unique past 4 years, but certainly worth noting.
Thanks for that context, Karen. The shift in focus to growth in an interest rate environment should be a driver for the next several quarters. But let's shift gears to stocks and the performance of the Wespath equity funds. We can finally start the update without saying that the Magnificent Seven once again led the broader market. Because as we noted earlier, lower rates were a tailwind for mid and small cap companies. The S&P 500 gained 5.9% on the quarter, and the small cap Russell 2000 gained 9.3%. Looking international, again, we're seeing that international markets and emerging markets outperformed the S&P 500. The MSCI EAFE was up 7.3%, and the MSCI Emerging Markets Index was up 8.2%. Karen, what would you note here?
The developed world started easing interest rates before the Fed, which has supported these markets. And we also saw a large fiscal and monetary package from China near the end of September. Chinese stocks are up roughly 30% since the move, which has been a key reason the emerging market index has such a strong rally.
Yeah, the move in China is something that the investment team is monitoring, and we expect to discuss client meetings this quarter. Even after the 30% rally, Chinese stocks have very cheap valuations, but some strong tailwinds from the Chinese government. Shifting gears, how did the Wespath equity funds perform on the quarter?
So let's start with the U.S. equity fund composite. On the quarter, the composite was up 5.8% net of fees, slightly behind the benchmark of 6.2%. The outperformance of small and mid cap was a positive contributor to the fund, but the biggest detractor was manager stock selection, which led to the fund being just below the benchmark. Meanwhile, the International Equity Fund Composite was up 8.1% on the quarter after fees, just in line with that benchmark return.
Thanks for that, Karen. One thing to note, in the July commentary, we discussed the most likely scenario for the rotation from the Mag 7 would be the earnings of these mega caps rolling over, alongside other earnings growth from other names in the index. And while the earnings for the mega cap didn't exactly roll over, the Fed rate cuts have analysts increasing their expectations for the mid and smaller names. So again, the markets are behaving as one might expect.
But the timing is always a challenge.
Yes, I agree. And we'll continue to watch to see if the mid and small caps can hit these new higher return expectations. So let's turn now to fixed income. Fixed income markets. We already discussed one of the big themes for Q3, with the Federal Reserve cutting rates after what seems to be a year and a half of waiting. With the yield curve shifting lower, the broad Bloomberg U.S. Aggregate Index was up 5.2% on the quarter, erasing the losses of the first half of the year, and now stands at plus 4.5% for the year. Karen, how did the Wespath funds perform in this new rate-cutting environment?
The fixed income fund composite was up 5.2% net of fees, beating the benchmark by 5 basis points. The slight overweight to high yield was a positive contributor, and also the 10% weight to international bonds helped, largely due to the dollar falling 5% on the quarter after the Fed rate cuts. The Inflation Protection Fund did underperform for the quarter and year to date. The primary driver was the fund allocation and issue selection to emerging market inflation-linked bonds, as these currencies, specifically the real, weakened relative to the dollar. The fund's allocation to and manager issue selection in global inflation-linked bonds also hurt the fund's benchmark relative performance.
So Karen, we have an election coming up on November 5th, and in these close elections, the markets tend to behave with more volatility. However, there's little empirical evidence that shows that there's an impact on the broad markets. Individual sectors may see some rotation depending on new policy measures, but not necessarily the broader market. Our colleagues Frank, Quach, and Roger are going to have a lot more of that later on in the webinar. Regardless, regular viewers have heard that the Wespath believes in long-term investing. which means we try to tune out the noise and the fear of missing out. For investing, that can mean not chasing the latest trend. This is likely to be a very noisy quarter, but we'll stick to our knitting of long-term investing while looking for opportunities that may result in dislocation in the market.
Thank you, viewers, for tuning in. For more detailed fund attribution information, please check out the reports available on the QR code here. As always, please feel free to reach out if you have any questions. We appreciate the feedback and your trust in Wespath.
Hello, my name is Trent Sparrow. I'm the manager of the Impact Investments program here at Wespath, and I'm happy to be joined by Johara, our Chief Investment Officer, and Sylvia, the Director of the Impact Investments program.
Hi, Trent.
It's been a while since we've talked about our positive social purpose lending program here at Wespath, and recently Johara and Sylvia were able to tour a property that we invested in suburban Chicago. But before we jump into talking about that property tour, Sylvia, can you give us a little bit of an overview of the PSP program and talk about your experience in working in that program here at Wespath?
Sure. Thank you, Trent. So the Positive Social Purpose Lending Program, or we'll refer to it as PSP for the most of our discussion today, is focused on investing in properties that cater to populations that are low income or in need. Mm-hmm. We have also done some community development investments through the program. And then a final smaller piece focuses on microfinance investments in developing markets.
That's great. Now, Johara, I know since starting at Wespath, a big priority that you've had is diving deep into our funds and really understanding everything that we do here. And as you've kind of looked under the hood of the PSP program, what excites you or what interests you about the program and the work that we do related to that program?
Yeah, thank you for asking that, Trent. I am so excited about the PSP program. It was one of the areas that I wasn't really familiar with. Mm-hmm. And so I've spent a lot of time with both of you and John getting familiar with it. And the part that's most exciting is that Wespath really found a way to be able to obtain our risk-adjusted returns that mm-hmm. are commensurate to the market rate, but in addition to making a huge difference in people's lives and supporting the housing crisis really here nationally, but also overall globally. So I know the importance of the work that's being done around affordable housing, and I thought it would be important for us to take a step back and share with the audience a little bit of what we learned through the Harvard study and some of the issues that we're sort of facing, and that how PSP sort of helps to make some sort of impact and difference around this housing crisis. So in reviewing the Harvard study, what we learned was over half of renters are cost burdened. Mm-hmm. And really what cost burden means is that 30% of your income, 30% or more of your income that you take home is spent on housing and utilities. And so that's difficult. And then more than 50% of Black and Hispanic renters are usually the individual groups that are cost burdened. Yeah. And so I think, especially for those families living in metropolitan areas, I think the salary range that they were quoting that you need in order to be able to sort of afford the housing is around $100,000 a year. Wow. I know. So I think it's amazing to be able to create a program here internally and have us have this expertise and allow us to support this effort. It aligns with the values of the church, but in addition to our goal in meeting our risk and return objectives. So
it sounds like you're pretty excited about the program.
I am.
And so for participants in our pension funds or in our funds or participants or our institutional investors, how do they get access to PSP or feel like they can invest in this?
Yeah. So most of our institutional clients are invested in PSP through our fixed income fund, or what we also call FIF. And that's really the main way to get that exposure. But knowing that we have been so successful in this program, and really kudos to you guys, is that we've been getting a lot of requests of how can they get additional exposure to PSP. And so one of the things that I've been working with you all on is hopefully finding ways for us to expand PSP throughout other funds of ours if we can, or just find other ways to get it to our clients since it's in high demand. So more work for you guys.
Which is a good thing. Which is a good thing.
And I would just add before Trent goes to the next question is we have invested $2.1 billion in the space through the program. So again, so much success. We've just focused on so many different types of projects. They cater to so many different populations in need that the ability to be able to expand on the program is going to be impactful beyond belief to so many more. So
Great.
Yeah. And thank you, Sylvia, for leading that. I know we've talked more broadly about PSP and kind of how it ties into our funds. I'd like to transition our discussion now a little bit more focus or narrow the discussion and talk a little bit more about your recent property visit to Broadview. Before I jump and ask Johara kind of her experience at the property, Sylvia, can you tell us a little bit about the property and the populations it serves and how it's really impactful for the residents that live there?
Yeah, it was one of my favorite properties that I've visited recently, and it was a real pleasure to have Johara join us as well. But the property is Broadview Senior Apartments, so it actually focuses on providing housing to seniors and seniors with special needs. The units in the property, we have 70 units, a lot of different amenities that I'm sure Johara will chime in on in terms of her feedback on that. And then also, similar to a lot of other projects, this was a recipient of a Green Standard Award or certification. So again, it kind of represents a property that we are very proud of and a property that is typical in our portfolio, focusing on populations that really need the housing.
Thank you, Sylvia. And Johara, Sylvia and I have been doing these visits our whole careers. This, I think, was your first visit to an affordable housing property. I'd love to hear kind of your thoughts of what you experienced walking through the property, and maybe you could provide us with some of your reflections on what went through your mind as you were walking the property.
You know what? My biggest takeaway about that is really a lot of the times when I'm communicating with you all on PSP, it's really transactional. It's about the numbers and the underwriting and making sure all of the investment aspect of it is making sense. What I got to see when visiting the live property was really how amazing something that could be viewed so transactional is actually having such significant impact. The part that resonated to me was like the community that was built around that property. The property manager truly knew the names and understood all the neighbors that were in that senior living. So as we would walk around, some of the neighbors would be using some of the facilities, and she would be able to talk to them and say hello to them by name. And so I thought that was fantastic. So not only are we providing opportunities for housing, but we're also creating a community, which is really what it's all about at the end of the day. I did also loved some of the facilities and community areas where there was like the library and just sort of the property manager mentioned how they're going to add technology to help support some of the seniors and having them access the internet. And so I walked away from it more encouraged and more empowered for us to figure out more solutions that are consistent sort of with our values and our mission. So
yeah, and I that's one thing I love about the PSP lending program is we're not only providing housing, we're creating communities. And these property managers, like you just described, they're incredible individuals who really focus on building relationships with residents of the properties.
Yeah, hopefully it'll have this domino effect across the board, whether it's on housing and education, et cetera.
Yeah, and so before we wrap up, just be interested, Johara or Sylvia, do you have any closing thoughts that you'd like to share with our audience today?
I will just echo Johara's comments on the personal experience. That's been one of my most fulfilling pieces of doing my job is, again, it's numbers. Yes, the numbers have to work, but when you actually get to meet the people that are able to live in these units and these apartments, you know that you're making a difference. So it's kind of a double line in terms of obviously making sure that this is the right kind of investment for our participants and institutional clients, but
Right.
at the same time, you're making a difference to people in the community, and it's amazing. So.
And I would probably just want to close out and really talk about the reason we're so successful is really, truly your leadership, Sylvia, and your leadership, Trent, in supporting John, and that the three of you have this great expertise in-house on underwriting and how to continue to make sure this program is successful. So I think that's a skill set that's unique to Wespath, and the goal would be to continue to leverage it and hopefully do more great things this way going forward. So thank you both.
Thank you.
Thank
and
you.
Thank you for joining us today. And I think I speak for the entire Impact team when I say we're very grateful for the chance that we get to do related to our work by providing not only market rate returns, but also being impactful in the work that we do out into the communities that we work in.
Welcome. I'm Frank Holsteen, Managing Director of Investment Management here at Wespath. I lead the team responsible for the Wespath investment funds. Today I'm joined by two of my colleagues, Quach, our Director of Public Market Investments, and Rashed Khan, our Director of Investment Research here at Wespath. Thank you for joining.
Hello, Frank.
We're only a few weeks away from the big U.S. election. I would say it's been an unusual election so far, with the incumbent candidate, Joe Biden, dropping out and endorsing his Vice President, Kamala Harris. It seems that it's currently too close to call the presidential election between Harris and Trump, and we hear it will likely actually be decided after election night because of the way votes are counted. Congress is also too close to call. Both houses, the House and the Senate, could go either way, leaning Republican or Democrat. We hear that the market dislikes uncertainty, and I think that's true, and this feels quite uncertain to me. And yet we observe that both stocks and bonds are up so far this year, and so I guess my question would be, how abnormal is this, and what is going on here?
And yes, Frank, it truly has been an unusual year so far. We looked at some information provided by third parties, and we're looking at the markets are up quite a lot this year. We looked at the 9 months of performance for S&P 500 for the first 9 months of this year, and sure enough, it's up more than 20% this year. But then we looked at a longer-term history, and we see that there have been other good years, and as well as some bad years for the 9 months preceding an election. However, there's just a lot of factors that go into the election. It's not going to a performance of the market. It's not just election. This year, interest rates and Fed's activities are other factors that also impact in the markets. Earlier, our colleague Karen and Joe also spoke a little bit about it, and they mentioned how the Fed's activities and the interest rates are probably a bigger impact to market this year than elections. So we really do see some unusual movements this year.
So that's something about returns, but what about volatility? You know, markets moving up and down in a more amplified way during elections. Thoughts about that?
Yeah, so Frank, in most election years, you do see a greater amount of volatility because there's just more unknowns. You know, you don't know who the candidates are, you don't know what their policy positions are, but you know, back to 2024 being somewhat of an abnormal year, we see that returns have actually been pretty stable. As Raj mentioned in his previous slide, returns have also been high. You know, that maybe has been driven by, you know, the Fed rate cuts, economic growth, but they've also been pretty stable. You know, despite the change in the candidates, you know, earlier in this year, they were both known though. You know, we knew that it was going to be President Biden and Trump, you know, the candidates, and then once Biden stepped back, we knew that was Vice President Harris who was going to be a candidate. So that removed that element of uncertainty, and we had a little bit more stable markets throughout. But you know, this chart we see here that in most years where there is a close election, there's greater amount of volatility because you don't know what's going to happen come election day. And it's really the uncertainty that drives volatility, and that's not what we've seen so far this year.
And what you said, Hua, is actually even more true if we look at the longer term history. So we look at a longer term perspective returns, and we notice that for 1 year period leading up to an election, the risk in the market, the volatility in the market is a little bit higher, and that's stemming from that uncertainty Hua spoke about. It's also a little bit higher for 1 month after the election, when you compare election year versus non-election years. However, other periods, though, we don't see that kind of a difference in volatility.
You just addressed market volatility leading up to the election and then following the election. How about market performance? We touched a little bit on market performance leading up to the election. What about market performance after the election outcome?
Yes, that is a question a lot of folks actually wonder about, and there may be some misconception that parties have a lot to say about how markets perform. We just haven't seen that in data. We looked at market performance over long periods of time after a win by a party, and we saw some data that goes back to 1930s. We've seen how portfolios perform for periods of 10 years after a party win. And we've seen after a blue win, some really good performance and then some not so good performance. The same is true for a red win, where we see really good performance years and periods and then some not so great performance. It just seems like there really isn't much that you can guess about the market from just seeing what parties win. Markets are more complex than that.
Mm-hmm. Well, maybe we can take it for a moment away from big picture market performance and talk about potential impacts on market sectors or industries. Thoughts about that?
Sure, Frank. We do have a long-term focus here at Wespath, and we use our multi-manager approach to those funds. And our managers are definitely looking at implications of the elections on specific sectors, industries, and we know that it can have an effect on specific industries. But generally, the performance, as Raj has shown, has been there regardless of what the party is. But we rely on our managers to really do that analysis, and I think having that long-term approach is really going to help us through some of the uncertainty in the markets.
And so I think, is it fair to say we, Wespath, will not be adjusting our investment program in anticipation of the election, but the asset managers that we hire are certainly looking at the individual investments within their portfolios? The company.
Definitely, Frank.
Very good. Well, thank you both for joining us this quarter. Appreciate it.
Thank you, Frank.